Hello, everyone, and welcome to our new accounting episode. Welcome, everyone, and let's start. We're going to have a very interesting topic today. So let's see what we have. Today, we're going to have the double entry. Let's see how this is going to happen. So, um, have accounting for today, and this is the double entry system for assets, liabilities, and capital. So let's see how is that going to work. So for account for double entry. So what is double entry basically? So that means for any transaction that we need to record in our books, it must affect two sides. So every entry happens, any transaction takes place, it has to be recorded into two sides. As you see here, it's a T account. So it's like a letter T, as you see here. The title goes here on top of this here. You write the account. Could be cash, could be bank, could be capital, could be assets, could be cars, could be whatever it is. And the left side, we call it the debit side. So this is the debit side, and this is the credit side. So debit and credit. Let's see the next one. This is very important here. I have the equation. The equation is assets equals liability plus capital. Assets equals liability plus capital. So now, any assets that is going to increase, as you see here, it should be in the debit side. Any assets that's going to decrease, it would be on the credit side. So let's say if you buy a car, let's say buying a van or a car for the business. So the car in this case would be under the car, under the van, or under assets, whatever you want to record it. So if this is a van account or car account, once you buy it, you're going to put it on the left side as a debit. That's going to increase your assets. If you want to write a depreciation amount that has been taken off the buying value, and that will decrease the value of the car. And that will be written on the right side. So that will be credit. Same as capital and liability. So let's take examples here to make it much easier and much clearer. So this owner started his business with $10,000 in cash. So as we said, it's a double entry. A double entry will affect two sides, or to affect two elements, or affect two accounts. So one account here that we have the cash account. So this guy started the business with 10,000 in cash. So he has put in his account, in his bank account, $10,000. This 10,000 is money in or money out. Ask yourself, this is money in the bank or money out of the bank? So obviously this is money in. So cash is an asset. Asset has been increased. So I'm going to put it on the debit side. One more time. Guy start his new business, putting 10,000 in his bank account or cash account. So think of this way, cash in or cash out. This is cash in. The guy deposit or put money in his account, bank account. That bank account, the money has increased. So this is money in. Money in will increase his assets. So cash is an asset. So since it's an asset and it has been increased, so it's going to go on the debit side. In the meanwhile, this money was business starter. That means it's a capital. Capital is right here. Capital has been increased or decreased. Capital has been increased. So you put it on the credit side. For capital, increase capital right here. Increase assets, which is cash, goes here. So both double entry. The cash goes in the debit side, capital, has gone to the credit side. So let's take the next one. This guy or this business owner paid $10 on cash to this person. This person is an account payable. So previous history that we don't know. He bought something from him before, and now it's time to pay. It could be the full amount, could be a part of the amount. However, it doesn't matter in this case. We just want to record this. The guy paid, business owner paid $10 to this guy, and this guy, this person, was an account payable. So whether you're gonna record it as an account payable or that person account name, it doesn't matter in this at this point. So let's say here, $10 in cash. Cash is an asset. So cash is gonna go here. Cash is an asset. $10 paid out. So this is money in or money out. Paid out, it's money out. So this is gonna decrease cash. So cash has been decreased, it goes to the credit side. Cash decreased, $10 and cash. Cash is an asset. Assets decreased, it goes here to the credit side. Meanwhile, account payable or this person account payable is liability. That your debts has been increased or decreased. You owe him, let's say you owe him $50 from before, and now you pay 10, your debts became 40. So that means your debts or your liability has been decreased. So therefore, debts decreased, liability decreased, it goes to the debit side. So under that person's account or account payable, you're going to debit that money because your liability has been decreased. Your debts has been gone down. So decreased goes right here. Okay, let's go to the next one. I hope this is making it a bit easier than before or more clear. Let's see the next example. I like to have this equation all the time. Put it all the time in front of you. It makes your life so easy when you do the double entry process. Now let's see. So the business owner now, he bought a van and paid in cash. So van and cash, those are the two accounts will be affected. Now let's take the van first. Van is an asset. Here's an asset. So a new van, that means assets has been increased, cars has been increased or decreased. Cars has been increased. So it's gonna go right there under the van account, and it's gonna be on the debit side because assets has increased. Next entry or the second entry, 4,500 on cash, that's paid. So cash is an assets, and assets has been decreased because it's money out. 4,500, money in or money out? That's obviously money out. Money out, that means my cash, which is an asset, has been decreased with this much. So I'm gonna go right to the credit side and write $4,500 on van. Okay, I think that's much easier now. Let's take the next one. The key idea here, keep this in front of your eyes. This equation or this process or this rule is gonna make your life so easy. Let's take the next one. The next one here, this guy or this business bought on credit. What did he buy? He bought shop fitters. Okay, so a shop fitters is you can consider it also as assets. So let's see here. What happens in my assets? First of all, let's take the first part. He bought on credit. So is cash involved here? No, no cash. He promised to pay the amount later on. So when a business buy on credit, it goes under liability, account payable. Account payable In this case, you owe nothing to this business, and now you owe him $12.50. So your ability has been increased since you did not pay in cash. So that's a debt for you. So a liability increase, right? So it's gonna go to the credit side. So you're gonna put this guy under the shop fitter. You can write him under account payable, or you can open an account for him if you like when it goes to keep bookkeeping. So shop fitter right here, and liability has increased. So I'm gonna go to the credit side. And meanwhile, my assets has been increased as well. So assets increased. I bought fixtures, fitters. I bought some shelves or fixtures, as it says here. So it's gonna go under assets or fixtures. So assets has increased, goes to the debit side. So $12.50 debit side here, fixtures or shelves, and $12.50 in shelf fitters, which is account payable, to the credit side. I think this is much easier than before. Let's see the next one. The next example, we have transaction today. So now let's see here. We have done all the transaction. Now let's see here. Let's go backward then. We have the cash and the capital. So cash account. So let's say, think this one, $10,000. And this side, that means it's money in or money out. $10,000 here. Oh, cash is an assets. Cash increased by 10,000, so that's money in. How about these? Decrease on the right side. So those are payment. Those are cash out. 4,500 and 1250. So those are money out. Cash assets is cash is an assets decrease. It goes to the credit side, so it's a debt. It's money out. Now next one we have the capital, $10,000. Here's capital. When capital increased, it goes to the credit side. So this is also capital increase. So that was the 10,000 deposit here. The 10,000 deposit in the bank, and guy start his business, and he got only $10,000 in capital and 10,000 in his bank. Next one, we have the van. We only have one van, and that's on the debit side. Van is an assets, debit side increase. That means it's right here. So this is a purchase of a van, and the fixtures, we have here $12.50 fixtures. That here starting one, the $12.50. And the next one here, we have the shop fitter. We also have a liability. So the $12.50 here as a shop fitter, as an assets, and also the $12.50 here also as a liability, was not paid, right? A $12.50 fixture, so this is the fixture account as an assets. Assets increase, it's going to go to the left side. And here's the $12.50 paid. Going to be paid later on in cash. Now let's see the review one more time. So we got cash account, we got capital, we got van, shop fitter, and fixtures. Okay guys, I hope this was helpful, and I'm very happy to see you today, and looking forward to seeing you for the next episode. Thank you everyone, and have a great day.